Hi students, welcome to DS Economics channel. Today we are going to discuss 2013 December Kerala set economics previous year question. This is your last part number 3. In this part we are going to cover from question number 81 to 120 questions. So those who come for the first time, please subscribe to this channel, and those who do not watch the previous part videos till now, they can watch in the playlist. I have given the link of the playlist in the description box. So let's get start today. Today's first question, question number 81. Among the approaches to the measurement of poverty, which method focus on the consumption expenditure at which a person's typical food energy intake is just sufficient to meet a predetermined food energy requirement? Cost of basic needs approach, food energy method, food share method, or none? It is called as food energy method. Option B, food energy method, because food energy intake method identifies the poverty line based on the minimum calorie requirement, linking it directly to consumption expenditure. Then question number 82. Non-material human capital in the form of improved knowledge, skills and health which enhance productive efficiency is called tangible capital, intangible capital, or sunk capital. It is called as intangible capital. Option B, intangible capital, because intangible capital includes education, skills, health, knowledge, etc. So these factors that are non-physical but crucial for productivity are called as intangible capital. Then question number 83. According to Levenstein, every economy is under the influence of shocks, stimulants, shocks and stimulants, or none? According to Levenstein, every economy is under the influence of shocks and stimulants, both shocks and stimulants, because Levenstein in his theory of economic development emphasized that economies are influenced by both shocks. Shocks means external disturbances and stimulants means motivators like incentives. So both shocks and stimulants are required. Then question number 84. According to Schumpeter, profits are due to innovation, low cost, more demand, or marketing expense. According to Schumpeter, profits are due to innovation. Schumpeter given the concept of innovation theory. So option A is the right answer. Joseph Schumpeter argued that entrepreneurs even earn profit by introducing innovations that disrupt equilibrium or new product, method, or markets. So option A is the right answer. Then question number 85. Which one of the following is not one of the indivisibilities as prescribed by the Rosenstein-Rodin for launching economic development? Indivisibility in production function, in consumption function, of demand, in supply of saving. So indivisibility in production function is there, but not consumption function, and indivisibility of demand also there, and in supply of saving also there, but only indivisibility in consumption function is not there in Rosenstein-Rodin model. So indivisibility, Rosenstein-Rodin emphasize indivisibility in production, demand and saving, but consumption function indivisibility is not a part of his theory. So B is the right answer. Then question number 86. An organism which is only found in the area being considered, that is called as endemic, biotic, or biomy. It is called as endemic. An organism which is only found in the area being considered in a particular area, that is called as endemic. Endemic species are those that are native and restricted to a specific geographic area. Then question number 87. Valuation based on the creation of hypothetical market in which preferences are stated by the consumer is known as travel cost method, hedonic price method, or contingent valuation method. It is called as contingent valuation method, because CVM is used in environmental economics to estimate non-market value like clean air, to estimate non-market values using hypothetical scenarios where consumers state their willingness to pay. Then question number 88. A foreign exchange transaction followed by an offsetting open market operation that leaves the monetary base unchanged. That is called as forward transaction, capital control, or sterilization, or swap transaction. That is called as sterilization. That is called as sterilization. Sterilization is a central bank's action to neutralize the monetary effects of foreign exchange interventions by conducting open market operations like selling bonds to offset currency purchase. Then question number 89, days occurs when lower cost imports from outside the union are replaced by the higher cost imports from another union member. Trade deflection, trade creation, trade diversion, or trade control. It is called as trade diversion. It is called as trade diversion because trade diversion happens under customs union when cheaper imports from non-members are replaced by costlier imports from member countries due to preferential treatment. Then question number 90, the occasional sale of a commodity at a lower price abroad than domestically in order to sell an unforeseen or temporary surplus to the commodity abroad without having to reduce domestic prices. That is called as persistent dumping, sporadic, or predatory. Persistent, sporadic, or predatory dumping. It is called as sporadic dumping. Sporadic dumping, option B, because sporadic dumping is occasional and unplanned, used to clear surplus stock in foreign markets without disrupting domestic prices. Then question number 91, which approach examines and integrates the effect of induced income changes in the process of correcting balance of payment disequilibrium by a change in the exchange rate? Elasticity approach, absorption approach, monetary approach. It is called as absorption approach, option B, because absorption approach focus on national income and expenditure. It says balance of payment improves if domestic output increases relative to domestic absorptions, or that is called as C plus I plus G. Then question number 92, a tariff expressed as a fixed sum per unit of a traded commodity, that is called as optimum tariff, prohibited tariff, scientific tariff, or specific tariff. It is called as specific tariff. Tariff expressed as a fixed sum per unit of trade commodity is called as specific tariff. A specific tariff is a fixed amount, that is suppose 10 rupees per unit irrespective of the commodity's price. Then question number 93, who introduced price speciflow mechanism? Price speciflow mechanism. Marcuse, Goldstein, David Hume, or Harberger? David Hume introduced price speciflow. David Hume proposed the price speciflow mechanism to explain automatic correction of trade imbalances in a gold standard system through gold flows and price level changes. Then question number 94, which among the financing facilities provided by IMF was established in 1997 to meet the need for very short-term financing on a large scale? Supplemental reserve facility, complementary financing facility, standby arrangements, or extended fund facility? It is called as supplemental reserve facility. Option A is the right answer, because supplemental reserve facility was created by IMF in 1997 to help countries facing short-term balance of payment needs, especially during financial crisis. Then question number 95, the purchasing power parity theory predicts that a fall in a currency's domestic purchasing power, as indicated by an increase in domestic price level, will be associated with a proportional currency dash in foreign exchange market. Depreciation, appreciation, or revaluation? It is depreciation. Depreciation, option A, because according to purchasing power parity, if a country's domestic prices rise, its currency depreciates to restore parity in international purchasing power. So option A is the right answer. Then question number 96, the gravity model relates the trade between any two countries to dash to the size of their economies, difference in exchange rate, or difference in money supply. It is related with the size of their economies. Option A, because the gravity model of trade states that trade between two countries is directly related to their economic sizes or GDP and inversely related to the distance between them. Then question number 97, the vulnerability of even seemingly healthy economies to crisis of confidence generated by events elsewhere in the world is termed crossing, contagion, collectivism, or collusion. It is called as contagion. Option B, contagion, because contagion refers to the spread of economic crisis or market shocks from one country to another, especially during times of financial instability. Then question number 98, ergonomics refers to the study of interrelation between ecology and economics, study of environmental economics, the study of efficiency of the worker. Yes, ergonomics refers to the study of the efficiency of the worker. Option C is the right answer, because ergonomics is the science of designing workplaces, tools, and tasks to match human capabilities, improving worker efficiency, safety, and comfort. Then question number 99, 4 Asian economies known as 4 tigers are Singapore, Taiwan, Hong Kong, South Korea, India, Sri Lanka, Nepal, Bhutan, Indonesia, Taiwan, Japan, China, India, China, Taiwan, Pakistan. 4 Asian economies known for 4 tigers. That are, first one is Singapore, second one is Taiwan, third one is Hong Kong, and fourth one is South Korea. Option A is the right answer, because these 4 Asian tigers achieved rapid industrialization and high growth rate from 1960 to 1990s. So option A is the right answer. Then question number 100, a bond that promises payment adjusted for inflation, that is called as junk bond, income bonds, index bond, or growth bond, that is called as indexed bonds. Index bond, option C is the right answer, because indexed bonds, also called as inflation linked bonds, adjust both principal and interest to inflation rates, protecting investors from inflation. Then question number 101, an approach to calculating real GDP that treats goods as providing a collection of characteristics each within an implicit price is termed hedonic pricing, cost plus pricing, Ben's limit pricing. It is called as hedonic pricing. Option A, hedonic pricing, because hedonic pricing adjusts the value of goods like computers or houses based on their features or characteristics, often using GDP and inflation estimate. The next question number 102, debt monetization mean. Debt monetization mean a unilateral decision by a debtor not to repay his debt, financing based on loans or the insurance of bonds, borrowing money to finance a deficit, the printing of money to finance a deficit. So debt monetization means the printing of money to finance a deficit. Option D, because debt monetization is when the central bank prints money, buys government securities to finance fiscal deficit, potentially leading to inflation. Then question number 103, the taxpayer's tax bill divided by his or her total income. It is called as marginal tax rate, effective tax rate, inclusive tax rate, or exclusive tax rate. It is called as effective tax rate. Option B, effective tax rate, because effective tax rate is the actual rate a person pays on total income, not just on the highest income bracket, which is the marginal tax rate. Then question number 104, the expenditure which the state may or may not incur is referred to as necessary expenditure, useful expenditure, superfluous expenditure, or primary expenditure. It is called as superfluous expenditure. Option C, because superfluous or discretionary expenditure refers to spending that is not obligatory and can be adjusted based on policy priorities. Then question number 105, the rate of taxation decreases as the tax rate or tax base increases in digressive taxation, regressive, or proportional. That is called as regressive taxation. Regressive, the rate of taxation decreases at tax rate increases. That is called as regressive. One decrease, then another one we can say rise. Here in regressive taxation, the tax rate declines as income rise. When income rise, tax rate decreases. When income rises, in regressive taxation, a tax rate declines as income rises, placing a greater burden on low income individuals, like for example flat taxes, sale taxes. So these are the different concept. And the taxation decreases, tax base increases, it is called as regressive. First one is this is progressive, means when income rise, tax also rise. Then progressive, then next one is proportional, and third one is digressive. So in proportional, whatever may be the income, but tax rate is same for all: progressive, proportional, and digressive. And another one is progressive and proportional, it is called as digressive. Then question number 106, which one of the following is not true regarding income tax? Shifting of the tax burden is possible. No, in income tax we cannot shift the tax burden because it is a kind of direct tax, so we can't shift it to the another person. Incident impact are on the same person, yes, this is right. Then it can be progressive, proportional, or regressive, yes, this is also true. But option A is not true, so here not true option is option A. So A is the right option, because income tax is a direct tax and the burden cannot be shifted to others, so the incident and impact fall on the same person. So option A is the right answer. Then question number 107, when a tax is levied on the aggregate sale of all commodities except those for which the law provides exemption is called gross product value added tax, turnover tax, general sales tax, or none. It is called as general sales tax. General sales tax, option C. A general sales tax applies to the sale of all goods except those explicitly exempted by law. Then question number 108, money burden of a tax on the person who ultimately bears, it is called impact, incidence, or shifting. It is called as incident. Ultimate or final burden is called incident. Initial burden, impact, and final burden is incident. Incident of a tax refers to the ultimate burden who finally pays the tax, and impact on whom the tax is initially levied, and shifting refers to the transforming of the tax burden. So option B is the right answer. Then question number 109, other things being equal, the demand for the object of taxation, the more will be the incident of tax upon the seller. Other things being equal, the more elastic, less elastic, or perfectly elastic, or perfectly inelastic. The more elastic the demand, the more elastic the demand for object of taxation, the more will be the incident of tax upon the seller. Because if demand is more elastic, buyers can easily reduce purchases when taxes, and so the seller bears more of the tax burden. So option A is the right answer. Then question number 110, which committee is associated with the structure of indirect taxation? Vancha committee, Raghuram Rajan committee, PC Hota committee, Rekhi committee. It is related with Rekhi committee, option D, because the Rekhi committee which was formed in 1993, made key recommendation on rationalizing indirect taxes in India. Then question number 111, the theory of tax shifting was developed by Marshall Ricardo, Walker Canard, Hobson Stein or Dalton. The theory of tax shifting was developed by Walker and Canard. Option B is the right answer, because Walker and Canard are credited with the early development of the theory of tax shifting, explaining how taxes can be transformed from one party to another. Then question number 112, if the supply of a commodity is perfectly inelastic and the demand is elastic, the entire burden will be upon the. If the supply of a commodity is perfectly inelastic, supply is perfectly inelastic and demand is perfectly elastic, then the entire burden upon the sellers, buyers then upon the sellers, or sellers then upon the buyers, or seller buyer. It's sellers then upon the buyers. Option B, because with perfectly inelastic supply, seller cannot reduce quantity, so that bear the full burden of the tax when demand is elastic. So it's sellers then upon the buyers is the right answer. Then question number 113, capital gains tax was introduced in the year 1956, 47, 52, 49. Capital gain tax was introduced in the year 1956. The capital gain tax was introduced in India in 1956 as part of the Income Tax Act amendments. Then question number 114, in a two-sector model, when consumption is 40 plus 0.90y and investment is 50, then equilibrium output is. We know that for equilibrium output, y is equal to C plus I. So here C is 40 plus 0.90y plus I, investment is equal to 50. So 40 plus 0.90y plus 50, 40 plus 50 is equal to 90, 90 plus 0.90y. So y is equal to 90 plus 0.9y. So y minus 0.90y is equal to 90. So y minus y means 1y. 1 minus 0.90 is equal to 0.10. Y is equal to 90. This implies y is equal to 90 by 0.10, or if we remove the point, then 900 by 10. So it is 9000. To after point it is 2 digits, so 2 digits, then 1 0 cancel, it is 900. So answer is 900. Option D. So D is the right answer. Then question number 115, zero based budgeting was first introduced in the France, USA, Germany or China. Zero based budget introduced in USA, first introduced in USA, United States of America, because zero based budgeting was first introduced in United States by Peter A. Pry in the 1970s. Then question number 116, the right of a person to retain that which is in his possession and which belongs to another until the demands of the person in possession are satisfied, that is mortgage, hypothecation, lease or lien. It is called as lien, because a lien is a legal right to hold property belonging to another person until a debt or obligation is fulfilled. So option D is the right answer. Then question number 117, loans granted by the banks both for buying capital assets and for working capital purposes, that is term loan, composite loan, bridge loan or consumption loan, that is called as composite loan. Option B is the right answer, because composite loans are those that provide finance for both fixed or capital assets and working capital needs often given to a small and medium enterprises. Then question number 118, simultaneous attempts by depositors to withdraw their funds from a bank is termed bank run, capital loss, capital gain or none. It is called as bank run. Option A, bank run, because a bank run occurs when a large number of customers withdraw their deposits simultaneously due to fear that the banks will become insolvent. Then question number 119, according to balance budget theory, the balance budget multiplier is equal to unity, greater than unity, less than unity or 0. So according to balance budget multiplier, the balance budget multiplier is equal to 1 or that is called as unity. In Keynesian economics, the balance budget multiplier is 1, meaning that an increase in government spending financed by an equal increase in taxes will result in a net increase in income equal to the increase in spending. Then today's last question, question number 20, call loans are loan backed by security, loan backed by bonds, medium term loan or extremely short period loan. Call loans are extremely short period loan. Option D, because call loans are loans given for a very short period, often overnight, and can be called back or repaid on demand by the lender, typically used in interbanks transaction. So it is called as extremely short period loan, that is called as call loan. So 120 right answer is option number D. This is all about for the today's session. I hope you enjoyed this video. If you enjoy, please like the video, also comment in the comment section if you have any doubt, and those who come for the first time, please subscribe to this channel, and those who do not watch the previous part videos of Kerala set, they can watch in the playlist. I have given the link of the playlist in the description box. So in the next video we will cover another year questions of Kerala set. So thank you so much for watching. Jai Jagannath.